Welcome everyone to a special Apt Wealth Partners event, Global Trends and Tensions Shaping Australia. I'm Andrew Dunbar, one of the directors of Apt. Just starting with some housekeeping. Everyone's on mute in this format today, but we've got a lot of time for questions at the end. So as we go through the presentations, please use the Q&A box in your Zoom menu to submit a question anytime, and we'll get to as many of those questions as we can at the end. Well, it's very topical today, 2023. It's been another eventful year, to say the least. Plenty of uncertainty. We're watching some terrible global events unfold at the moment. Here at home, we've got tough conditions with interest rate rises and inflation. It's putting pressure on the cost of living for a lot of people. And then technology too. It's changing at a rapid pace, and we're seeing the evolution of AI, such as ChatGPT. And that's making many of us wonder, what's next? How do we invest in these times? So we've got the Apt investment team working hard behind the scenes to stay abreast of these developments. But we've assembled a really good panel of speakers today to explore some of these issues in detail. So without further ado, I have the pleasure of introducing David Bassanese. David's an author, a columnist, an investment strategist, and a macroeconomist. He is, in his role with Betashares, he develops economic insights and portfolio construction strategies for retail and advisor clients. So thanks for joining us, and I'll hand over to you, David.
Hi, sorry, I was on mute there. Yeah, great to be with you all. And thanks for the opportunity to present to you today about the economic outlook, always evolving, and some commentary with regard to the financial markets. Just to check that this is, there we go. Obviously, this is just general economic information, in no way personal advice. You've got some very good financial advisors at your disposal. So just the usual disclaimer here applies. And I'm breaking up my talk today. I'm going to talk for about 25-ish minutes, breaking it up into just a review of the economic situation as at the moment, a look forward in terms of the economic outlook, how things, base case in terms of how things may evolve, and there's obviously risks around that, and then some of the market implications for that. So firstly, in terms of the economy, look, first and foremost, the biggest challenge still globally is dealing with the post-COVID surge in inflation that we experienced over 21, started in 21, really gathered steam in 22. Our central banks have responded by raising rates, trying to slow growth, but inflation is coming down, as you can see in this chart. So there's a couple of measures of underlying inflation. So it strips out the more volatile components and gets you, a sense of the more underlying trends. And so in Australia, we use the trimmed mean, and in the US, they have a measure that excludes food and energy. So you can see there in Australia, inflation basically peaked late last year. It's been coming down. It probably hasn't come down quite as fast as the RBA would hope. Hence, we've had a few more rate rises, and most recently in November. But it is moving in the right direction. And importantly, in the US, it's moving in the right direction. In fact, they've made more progress in seeing inflation come down. So firstly, it's peaked. It's coming down. It's still too high, but at least moving in the right direction. Some of the conflicting inflation pressures, this is what we're dealing with. And really at the moment, it's like, what we saw is that the initial surge in inflation was driven by the goods sector. And this is because we had although we were locked down during the pandemic, demand for goods increased because people weren't able to travel, go to restaurants, and they were sort of locked into their homes. They bought up a lot of stuff that was needed to be imported. Meanwhile, production facilities around the world have been shut down or limited. And so we saw a big surge in demand in prices to sort of ration the market. Now, goods inflation has been coming off. We've seen food, clothing, furniture, even housing construction costs coming off. But we've got residual strength of inflation in the services area, things like housing rents, financial services, things like insurance, energy costs, But I guess here, even energy costs and rents and insurance, these are costs that service sector companies have had to bear, and so they've had to pass that on to the higher service sector prices. So, if the price of a hairdressing, price of getting your haircut's gone up, it's not that they're necessarily just jacking up their prices to, pad their profit margins. They're having to pass on the higher cost of rents, higher cost of insurance. So in a way, I think a lot of the service sector inflation we're seeing is really the flow through of the goods inflation that we initially saw, but it's now being passed through to the services sector. But so the hope is going forward is that services sector inflation will start to come down in the same way we've seen it in the goods sector. Central banks, look, they have continued to raise rates this year, but fair to say that they've slowed the pace. So you can see 23, we didn't get as aggressive interest rate increases we saw in 22. And more central banks are talking about close to being finished in raising rates. I think in the US now, probably a very good chance that we won't see another interest rate increase given the declines in inflation that we are seeing. In Australia, and the debate now in the US has really moved to when will they cut interest rates, which I'll touch on in a minute. In Australia, again, inflation has come down, not quite as quickly yet, so there is probably more of a risk that we get at least one more RBA rate rise. But I think the big picture here is that we are close to the end in terms of the tightening cycle that's been underway since 22. Meanwhile, the other, I guess, good aspect of the economy at the moment is that despite inflation's coming down, it's still a little bit too high, but moving in the right direction. Central banks have raised rates, but we've seen the rate rises to date have not really, they've slowed the economy, but we've not tipped into recession. So got a chart there of unemployment rates in Australia and the United States. And you can see that they've basically been going sideways in this still quite low level. In Australia, the unemployment rate touched 3.4% early last year. It's gradually moved a little bit higher to about 3.7. In the US, it's now at 3.9. But look, in the main, economic growth has held up reasonably well. Consumer spending has slowed, but we have not, at this stage, tipped into recession, which was the big fear late last year. All the rate rises that we've seen, would that, cause a big slowdown in the economy? At this stage, it's been a relatively gentle slowdown. In Australia, in the consumer sector, somewhat more harsher, but overall, growth has been holding in. And you might ask why, and I've just sort of got some points there, just again, focusing on our economy. In the main, so consumer spending in Australia is about 50 to 60% of national output. So where consumers go, so goes the economy. And that has been slowing down over the past year. The hit to real incomes from higher interest rates, from the increase in inflation itself, which has cut real incomes, has led to consumers cutting back their spending. We've also had a housing construction downturn. So those have been the two drivers of the slowing of growth, but it's been offset by, first and foremost, a big rebound in immigration. In fact, much stronger than the government expected, much stronger than the Reserve Bank expected. So what happened there is we had a build-up of people applying for, visas during the shutdowns during COVID. Due to the borders shutting down, they weren't obviously able to come into Australia, even though they had a visa. And then when the borders reopen, we've got an almighty rush of people coming in with their visas in hand. And I guess governments couldn't. Well, it seems as if they couldn't control the numbers coming in. Once you've got a visa, you're free to come into the country. And I think that more came in over the past 12 months than expected, which overall kept spending higher than it would otherwise be. So domestic residents have been slowing down their spending, but that's been partly offset by higher tourism and more spending from foreign students, but also just more people coming in and living in the country. Also, we're going through a public infrastructure boom. So a lot of state governments, I'm sure you're looking at cranes and tradespeople on the roads and whatnot. We're building a lot of tollways, railways in Sydney metros, and all of that is adding to demand. and business investment also picking up. I've got poor productivity there. I mean, productivity is output per worker hour. And what's been interesting in Australia is that employment growth's remained pretty strong this year, even though GDP growth has been relatively soft. And so that poor productivity, in a way, has meant, it's helped support employment growth. And again, there's one curiosity at the moment is the working from home movement causing a lot of people to have jobs, maybe having many jobs, and maybe that's contributing to the decline in productivity. Fiscal support, so governments have not been. Central banks in the main have been the main drivers of the slowdown in growth, raising interest rates. Governments have sort of been on the sidelines. They haven't really tightened the budget all that much. And in fact, there's been some packages to support households, rental assistance, electricity rebates, these sort of things, which actually try to blunt some of the impact of rate rises and higher inflation in spending if the government's turning around and giving you some support in that regard. Also, households have been running down their savings, and they built up a lot of savings during COVID. So consumer spending in Australia would have been a lot weaker given the weakness of income, were it not for people dipping into their savings rates. And just on China quickly, China's economy has been slowing down, but not as much as you would think, given the housing problems that they're dealing with at the moment, overbuilding of housing, because infrastructure spending is holding up, and the production of electric motor vehicles is holding up pretty well. So that's the state of play. Just to summarise, inflation has peaked. It's coming down. It's still too high, but it's moving in the right direction. Central banks have raised rates, but they're close to the end of the tightening cycle. And encouragingly, we haven't had the recession that many feared. Growth has slowed, but overall, it's still been holding in reasonably well. In terms of the outlook, so this is a chart. These are forecasts from the Reserve Bank themselves and the Federal Reserve, the US Central Bank, of those underlying inflation measures. You can see the RBA is expecting inflation to continue to gradually fall, get back to the target of 2 to 3% by mid-25. Now, I actually think there's a good chance that we get there quicker. I think the RBA is being a little bit conservative in that. And so my call is that, we may get back to 3% in terms of underlying inflation later next year, rather than, late in 25, which would be good news, and it would mean the RBA could move to cut rates a bit quicker. And that's because I think the service sector inflation that we're seeing will start to ease as those one-off cost pressures that they've had to pass on will basically, be absorbed, but they won't need to continue to pass on those cost increases. And also in the US, they've got inflation going back. In the US, the target is 2%. So the Federal Reserve there is, again, also reasonably relaxed in terms of waiting for inflation to gradually decline without having to tip the economy into recession to achieve that. Again, it helps that inflation has been moving down. In longer-term inflation expectations by businesses and households is also still relatively contained. So that gives central banks some comfort to sort of wait, not have to sort of, push it too quickly down. So I think, further gradual declines in inflation are likely. And in fact, my base case is that we actually see faster declines in inflation next year than central banks currently expect. And just on that, I mean, again, I won't probably go through this in a lot of detail, but this is US inflation. Again, when you think about global financial markets and even the Australian market, what's happening in the US is absolutely critical because it's the most important economy in the world. It's the most important financial market. So, we spend a lot of time analysing that economy very closely. And this is where you break down the underlying inflation measures. So core inflation is the orange line. You can break it down into goods, services and housing. And you can see that goods inflation has come down very nicely. It's almost back to pre-pandemic levels. We are starting to see housing inflation, which is largely rents, rolling over. And we do know from the private rental market that rents have flattened off. And with a lag that feeds through to this measure of housing inflation in the US. So again, pretty good confidence that housing measure there which did touch 8%. It's now down to 7%, will continue to decline over the coming year, but possibly back to 2 to 3%. That leaves that black line, which is services, which has been sticky. As you can see, it's peaked, hasn't come off as much, but I think that will be the story of 24, where we start to see a broadening of the disinflation into the services sector, helped by a further easing in US wages growth, a softening in the economy, some uplift in the unemployment rate, which will take pressure off wages and take pressure off service sector inflation. Unemployment going up, and again, we are looking at a still period of below trend growth. The central banks are anticipating a modest increase in the unemployment rate. And again, I don't quibble with this. The central, if you look at Australia, the RBA's got the unemployment rate going from 3.7 to 4.25 by late next year. If inflation comes down more quickly, we may not even get that, because the RBA may then cut rates and support the economy. We won't need to see unemployment go that high. But even that would be certainly a soft landing, not a recession. To get a recession, you'd need to see the unemployment rate, into the high 4s or over 5. And so that is still consistent with a soft landing. And if you look at the US, also, pretty good. Well, at the moment, the Fed think that they can get the job done with a relatively gentle increase in the unemployment rate, which would be pretty good news if that can be achieved. And I actually think, again, given we're seeing wage inflation in the US coming down, even at these low levels of unemployment, there's not a reason for central banks to get too aggressive here and push the unemployment rate a lot further. So I think that's still a reasonable outlook as well. This is a chart of central bank. This is what financial markets expect central banks to do with interest rates over the coming year. The black line there is the latest assumption. And so firstly, if you look at the RBA, the markets basically are pricing in, a modest chance of a further interest rate increase. So currently the cash rate is 4.35%. They've got it going to potentially 4. So basically they're saying there's a 10 to 20% chance of one further rate rise. But then maybe a 50 to 60% chance of one rate cut later next year, and then rate cuts starting in 25. I think the RBA, if I'm right on inflation, they could well cut rates by 50 points next year. So I think the markets at the moment are probably underestimating what the RBA might do in the second half of next year. There's a risk that the RBA does raise rates one more time in February if the December quarter consumer price index in late January is on the highest side. I don't expect that will happen, so I don't think they will do that. But I just pose that as a near-term risk. And if you look at the US now, the markets there have gone quite dramatic in terms of pricing and rate cuts. So in the US now, markets are expecting, up to 3 or 4 interest rate cuts by the US Federal Reserve over the course of next year. If anything, maybe the markets are too optimistic. So maybe the markets are not as optimistic on rate cuts in the Australia as I think they should be, and maybe a little bit too optimistic in the US. But nonetheless, the markets are forecasting that we are close to done in terms of raising rates. And the next major move in rates is probably down in 24, which, again, given the inflation outlook, I think is a reasonable expectation. What does this mean for financial markets? Firstly, bond yields. This is the chart of Australian and US 10-year bond yields. And you can see, the story for those investing in bonds over the past couple of years has been pretty dire, in that we've had a big increase in bond yields. So the value of bonds has been falling. So the returns on fixed income bonds has been not great. This year it's close to flat. Last year it was negative. But I think bond yields have peaked, and they will decline over the course of 24 as we move towards central bank rate cuts, and that's going to support better bond market returns over the course of next year as those bond yields. So at the moment, 10-year bond yields in the US, in fact, since this overnight, they've now dropped to about 4.15%, having touched 5% as recently as mid-October. But my expectation is that bond yields in Australia and the US can get below 4, and in fact maybe go to 3.5%, if not 3.25%, by late next year, as markets more confidently start to price in rate cuts. Aussie dollar, I think, can continue to strengthen. You can see it touched a low of around about 62 cents a few months ago. It's now shot back up to around, in fact, overnight it's now around 66 cents. But next year, I think two things are going to happen. The Fed will cut rates more deeply. Well, the US Federal Reserve raised rates more aggressively than most other countries. So as things normalise, they'll cut rates by more, and that will help put downward pressure on the US dollar. And also, just as optimism with regard to global growth starts to improve, that'll be supportive of the Aussie dollar, because it's seen as a commodity currency, and it tends to do well in that environment. So I'd imagine the Aussie dollar, good chance it breaks up above 70 cents, maybe to the mid 70 cent range by late next year. House prices, look, they've had a remarkable recovery over the past year. You can see prices declined nationally by about 7.5% over the course of 22 and into early 23, and they've rebounded and taken, they're now back at record highs. Now, going forward, interest rate cuts eventually may be supportive of the market. The only constraint at the moment is affordability is so poor. House prices relative to income, even given interest rates, mortgage affordability for the average homeowner is pretty poor. So I think we're reaching a level where affordability constraints will limit the degree to which house prices continue to move higher here, and they may start to level off and go sideways, and maybe even pull back a little bit if we get more supply coming back onto the market. People try to, at the moment, one of the drivers has been people holding off selling their homes, but maybe they now take advantage of those high prices and we get more units coming in. Also, immigration, which was very strong over the past 12 months, will slow back to a more normal pace as well. So I think a flattening out of house prices is the more likely outlook over the coming year. Share markets, I think, can grind high. You can see our markets had not a great year this year, and we've been in this very choppy range for the past couple of years. And really, the story in Australia overall has been, we had a big surge of commodity and energy prices following Russia's invasion of Ukraine. We got a big lift in earnings through last year. Our market briefly outperformed, but earnings over the course of the past year have been pretty weak, and our market's actually, if anything, has been pretty flat, net on net, whereas the US market has continued to, with some volatility. The US market's up almost 18% this year, whereas our market's been flat. But I think the story next year will be lower interest rates, improving growth outlook, as certainly by the second half of next year, and corporate earnings, which are already still rising, continuing to rise. So as we get through the rate hikes and we start to focus on the rate cuts, and lower inflation can support a rebound in economic growth, I think equity markets can continue to grind higher. And just on that, I mean, the last chart I have here, if I can get this to move. It's gone stuck on me. We'll see. There we go. Yeah. So and Cameron will talk about this a little later in a second. The big story in terms of equity markets in recent years has been the dominance of technology. The big tech names, I'm sure many of you are familiar with, Amazon, Google, Facebook. They have done very, very well really over the past decade or so. They had a dip down through 22 when interest rates went up, but they've rebounded since late last year, along with equity markets generally. But also supported by the new infatuation with artificial intelligence. Many of the big tech companies are going to be well placed to take advantage of artificial intelligence. So they've continued to do very well, but valuations are getting a little bit stretched, and maybe I think they will still continue to do reasonably well next year. But I think what we may see is potentially a rotation to some of the cheaper parts of the market, some of the value parts of the market, maybe energy, maybe financials, the consumer, non-tech consumer stocks, listed property will do well as interest rates decline. So I guess one of the question marks over next year will be, will that big tech dominance continue, or will we see a rotation into some of the other areas, including Australia's market, which again, as I said earlier, has underperformed this year, along with everything, but virtually everything other than big tech has underperformed, or big US tech, I should say. But that's going to be an interesting one for next year. But with that, I will conclude and hand back to Cameron to take over.
That's great. Thanks very much, David. Really interesting stuff. I'm sure there's a lot of questions that have come out of that, so we can get to those questions at the end. I can see the questions are coming through in the Q&A box, so keep those questions coming through as we go through. But I will now introduce Cameron Gleeson. Cameron is an executive director and senior investment strategist at Betashares, and Cameron's responsibilities span supporting the distribution channel. He works alongside the portfolio management team, and he's going to share some insights today into technology investing in this environment. So interesting stuff, and I'll hand over to you, Cameron.
All right, thanks very much, Andrew. Thanks very much, everyone, for joining us here today. It's great to be able to talk to you all. I will just, yeah, great. So I got the slides working. They're a bit sensitive. Hold steady. So I'll lead off on that final point that Dave was really talking about, which really has been the story of equity markets here this year, and the question that we're starting to really address is what's going to happen in 2024. In particular, as the header says here, can Nasdaq's performance continue into 2024? And as David pointed out, if we look at a global equity benchmark, if you were to strip out the big tech, the Magnificent Seven, if you like, or those AI winners, the overall global benchmark or US equity global benchmark would have been flat to down. So these small number of very large tech companies actually held up the performance of those broad benchmarks this year. So it's an interesting position that we've been in. And if we look at NDQ, which is our Betashares Nasdaq 100 ETF, the performance of that fund has been up about 50% year to date. So I guess you can sort of see the rebound in that blue line shown there from the year 2023. And the question then becomes, well, if the valuation multiple that we use, which is forward price to earnings ratio, is currently at 28. So if you wanted to buy the Nasdaq, you'd have to pay 28 times next year's earnings. If that's at 28, is that expensive? Is this AI buzz all in the price? Is there anything more than that? Is there a reason to invest from this point here? And I guess I'd just maybe point to really the history and the pedigree of Nasdaq companies for a look into what might play out in the future. It's really quite interesting to look at the history of the Nasdaq and the companies in there. Excuse me, we've just got a bit of a sensitive mouse here. Interesting to look at the history of the Nasdaq and their investment in as a percentage of sales of Nasdaq companies versus the rest of the US equity market. Nasdaq companies are on average spending 7 times as much on R&D. And clearly, if you're spending on R&D, the idea is creating, innovation. And obviously, leveraging off that innovation, you're able to drive up earnings. Well, how's that played out as we'd expect? To take a look at an example company, we can look at this comparison here. This chart here shows the quarterly revenue of ExxonMobil, the global oil giant, shown in grey, over about a 20-year period, versus Microsoft's quarterly revenue. Now, Exxon, is operating in a very, very mature industry, so subject to the forces of the economic cycle and geopolitical tensions. And clearly, we can see a very cyclical stream of revenue for that company. We compare that to Microsoft. Now, this is a company that's continued to invest in new areas of structural growth. As I point out there, enterprise, so your Microsoft Office suite, gaming, search, cloud, cybersecurity, AI. It's been this continued investment which has allowed them to increase their addressable market of customers, and increase basically the dollar capture from those customers. That's led to this revenue growth. And if you look at that revenue figure, that's quarterly revenue. So there is some seasonality there, but if you were to take that on an annual basis, it's a very smooth line in terms of that growth. One of my colleagues actually found an article which was written by Bloomberg about 10 years ago, and the title of the article was "Microsoft's Useful Life May Be Near Its End." So that was 10 years ago. And Microsoft, I mean, if you cast your mind back, they were maybe not quite as popular as they are now. Apple had come out with the iPhone. Microsoft looked a bit like old tech versus some of the other companies. But what the reporters failed to recognize was the massive investment in innovation that Microsoft was doing. So they were plowing around about $10 billion a year into Azure, which is their cloud computing service. That was a loss-making business at the time. It didn't seem like it was necessarily going to become what it is today, which is the behemoth and really the driver of a lot of growth of Microsoft's earnings. That cloud business currently earns them $110 billion per annum at a profit margin of about 40%. So you can sort of see that taking this long-term approach, investing in R&D in businesses that have a long lead time to growth, can pay off, and certainly has done so for this company. Just to look at underlying fundamentals across the broader suite, so the NASDAQ index, I think this chart here, it sort of tells the tale as to where we've been over the last, sort of say 5 years or so, and then maybe a look into the future. So in the pre-COVID period up to the end of 2019, no surprises there. We all know about the increasing level of penetration of these large tech platforms, and that obviously led to strong sales growth and therefore earnings growth off the back of that. Now, I've actually excluded the year 2020 from this period because, as we all know, the rest of the economy shut down and those tech platforms did very well. But just to take the snapshot between the end of 2020 through to 2022, we saw a different picture. And that was the reopening of economic activity. We saw that increase in inflation. All of this fed to a greater degree of earnings growth for cyclical companies, tighter supply of products and services in traditional industries, saw very strong earnings and in fact, revenue growth. Now, at that time, people started talking about NASDAQ companies looking bloated, and they were a little bit on the nose. We saw that strong drawdown in performance. If we look at where they sit now, the outlook in terms of earnings growth, and this is consensus analyst estimates for earnings growth for the NASDAQ over the next 3 years, is incredibly strong. And while we can see how something like AI is starting to feed into this. So again, just to talk about Microsoft, the Copilot product, where they charge an additional $30 a month of subscribers for this, effectively this it's additional assistant you get within Microsoft Office. That's obviously going to add some revenue growth. Where AI is really helping is in terms of driving an incremental increase to their cloud businesses, because cloud computing really is all about data, and the growth of data, it already was nearly exponential. With AI, you're seeing an increasing level of growth there. And we can already see them starting to invest more heavily in AI. So for example, if you look at the sales of NVIDIA's H100 GPU chips, these are the chips used to train AI computers, far and away the largest buyers. Almost the entire stock has been bought up by the very largest names in tech. So for example, Meta, Microsoft, Google, and alike. So these companies are still investing in future growth. And I guess the point is that on that 28 times current earnings, in terms of is that expensive or not? Well, what I kind of say with a high quality growth exposure, you'll find that it is always going to trade more expensively than the broad market. And if we, rather than looking at this year's earnings, if we look at the earnings in 3 years' time, given this strong earnings growth that's expected, that price to earnings ratio drops from 28 to about a ratio of about 18. So we start to see, if we're looking beyond this year's earnings, because obviously when you buy a company, you're not just buying the current year's earnings, you're buying the entire earnings stream. If we look into the future, if these companies can deliver on their expected revenue growth, then they're starting to look quite attractive. And I think there's a strong case that these companies have been able to deliver in the past and will therefore, maintain strong growth, some of these strong growth engines into the future. The other point on the NASDAQ, which I think is quite interesting, is if we look at, a lot of other US corporates that aren't in the NASDAQ. So, if I think, for example, JP Morgan, as an Australian, I don't have a JP Morgan bank account. Home Depot, another US large corporate that's not in the NASDAQ. I don't shop at Home Depot. But, I do use an iPhone, which is from Apple, and I use WhatsApp, which is Meta, and I use Google to search, which is Alphabet. NASDAQ companies have revenue exposure, which is really quite representative of the global economy. And I show on this chart here the revenue breakdown of the NASDAQ versus MSCI World, so the global representation of revenue breakdown from listed companies. So this is an exposure which truly is a global diversifier for Australian investors. But also, if you look at our equity market, we've only got about 2% in tech. So having something like the NASDAQ gives you a good sector balance against the banks and miners that we have here in Australia. Now, just to move on from the NASDAQ, another fund that I think is perhaps flying a little bit under the radar, but certainly has some very strong tailwinds, has performed incredibly strongly over its period since inception, is HAC, which is Betashares Global Cybersecurity ETF. This is a fund that invests in leading companies in that cybersecurity industry. And there's been some very strong tailwinds. We obviously all read the news and we're aware of some of the large, well-publicized hacks. For example, Optus or DP Ports are some of the most recent ones to hit this country. Now, I think this is a very interesting theme for a number of reasons, and we can sort of touch on the AI element to this. But in the near term, cybersecurity spending is really anchored in what companies are focusing on for their IT budgets. And we've seen consistently that security software, as it's generally described by corporates, has been one of the highest areas of spending and one of the greatest areas of growth and prioritization. Corporates and boardrooms are becoming very much focused on the cybersecurity threat and the recognition that with more data stored in the cloud, we need to increase the security in the way that data is managed. Now, I mean, some of those areas of innovation, AI is really interesting because it offers a threat. It's actually a threat in terms of cyber criminals. The ability for generative AI to generate, really, really realistic conversations in terms of email dialogue means that if you like, the threat surface is greater. The ability to have a phishing attack at scale, which is really realistic and quite effective, has only been increased. But AI companies, like if we take, for example, CrowdStrike, also have AI-enabled solutions. So, for example, CrowdStrike has a solution called Charlotte AI, which means that you don't just need to be an IT person to operate cybersecurity solutions. It's enabling a wider audience of potential individuals in a company to access cybersecurity solutions. And that's really important because where we're sort of seeing a lot of the threat in cybersecurity isn't necessarily always at those large companies at the Optus level. It's in fact in the small to medium businesses where you're seeing ransomware attacks and alike. So having tools that someone can use if they're operating a small business and they're not necessarily a cyber expert are going to be really important. So we've seen that opportunity in AI there. Obviously, increased government involvement. You may have read about Australia's cybersecurity strategy that just got released, or, for example, that the critical infrastructure laws around cybersecurity have now been extended to include Optus. So that government involvement and the requirement by governments or corporates to do better in cyber is a key driver of growth. And what we are going to see next, we haven't yet really seen that yet because quantum computers aren't really on the scene as yet. But quantum computing allows really the cracking of a lot of current encryption technologies and passwords. And so this is obviously going to be a threat, but also provides an opportunity. Quantum computing can allow for more sophisticated ways of encrypting. So we're not there yet on quantum computing, but you can sort of see how all of these developments sort of lead to a growth in terms of the product set for cybersecurity companies. And no surprises that they have performed incredibly well in terms of an investment, and I think they're well placed to do so into the future. Now, just finally, I'll just touch on the market impact, and this is just a selection of some of the most recent global breaches that we've seen. And we tend to see that whenever there is a large, well-publicized breach, cybersecurity companies do well off the back of that. This shows their performance during those breach periods for some broad market indices. So I think that hack or investing in cybersecurity is another interesting angle to play technology, and also the growth of AI, and one that is worthy of consideration. Right, I'll hand back controls there, and I think we're going to have some Q&A.
Great, thanks, Cameron. Gee, I'll be rushing off to change my password, I'll tell you that much. It's fascinating stuff, isn't it, this AI? And, I was telling the team the other day that my wife tells me I'm a lot like AI. I sound convincing, but really I'm just full of rubbish. So, yeah, we'll see how it evolves. It's very interesting. Thanks, Cameron. Really appreciate that. Now, joining us for some Q&A is Apt Wealth's Acting Chief Investment Officer, Adam Betashares. So if any of the audience have any questions they'd like to ask David, Cameron, or Adam, then please put them in the Q&A box and we'll try and get through as many as we can. I'm going to try and manage this as we go along. So a couple of questions have already come through. Might start with a question about war, which we didn't really touch on during the conversation, but we're seeing Israel's war on Hamas at the moment. We've had the Russia and Ukraine conflict. How do you think these wars might impact the economy and the inflation picture into 2024? Any comments on that?
Want me to have a crack?
Sure, David.
Yeah, look, in all of these things, I mean, the two questions investors ask when these sort of terrible events happen is, what countries are involved, how big are these countries, or how big a direct impact on economic growth in terms of global growth will it have, to the extent that their economies are going to be negatively affected by war. What do they produce? What is the disruption to global trade in different things? And what is the risk of contagion, the war spilling out to other countries and other potentially more important countries? Now, in terms of Russia, Ukraine, and even the Hamas attack on Israel, apart from Russia, I mean, Ukraine and Israel and Gaza, of course, relatively small fry in terms of the global economy. So the direct impact there has not been that great, and so it's still being contained. Now, the areas that have been affected, in terms of Russia, Ukraine, there was obviously a risk in terms of oil prices, a big disruption to the supply of oil and the supply of food from Ukraine. But we've seen that those supply disruptions, particularly in the case of oil, didn't last very long. For good or probably for the reality is there are a lot of sanctions imposed on the export of Russian oil, the use of Russian oil, but Russia has got around those, and many countries have still taken Russian oil. And as a result, the supply constraint that we thought might have come didn't really pan out. And so oil prices, if anything, came down. And unless there's a further, escalation there, I don't think we are going to see a major hit on the oil front. Now, and similarly, when in the Middle East, the risk was that if a country like Iran got involved in the war and there was a disruption to oil supply through the Middle East, obviously a big source of supply, either through sanctions or attacks on ships and whatnot, that would disrupt oil. But again, we haven't seen that. We haven't seen Iran getting dragged into the war, at least directly. And so there hasn't been any pressure to impose sanctions on Iran, and the oil has still managed to be flowing. So in both cases, the war, as horrible as it is in those particular countries, at the moment, Gaza and Ukraine, it is being contained, and the disruption to commodity markets hasn't been that great. And so I think that will go, if anything, as cruel as it sounds, I think markets have moved on and they see that these things are going to be contained. And we're not seeing a big hit into commodity markets.
Excellent. Yeah, thanks, David. That's good. David, while you're talking, there's another couple of questions here focused on you. One is China. You talked a little bit about China having some issues in their property market at the moment. how do you see the geopolitical tensions with China, the troubles that they're having in their economy at the moment? How do you see that playing out and the impact that that might have on Australia as well?
Yeah, so China, look, is obviously slowing down. Its economy is not growing at the 10% rates we saw a decade or so ago. It's still growing. I mean, it's still growing, at a 3% pace. The property sector, there's a major imbalance in the property sector. So they overbuilt homes, basically a big bubble in housing construction fueled by, a whole bunch of, basically excessive lending into this area. And they're nursing that back to health. I mean, the beauty of that, or not the beauty, but I mean, a lot of this is all government controlled. It's ultimately, if that all the debt in the property sector is domestic debt, it's not a question of foreign debt, and a lot of the debt that developers own is owned to banks who are owned by the government. And so ultimately, if push comes to shove, it's the government that wears the debt, the debt fallout. What it means for the economy is that the contribution to growth. So I think the financial impact of it will be contained. Ultimately, it'll be the government that wears all the costs. But the impact of the economy slowing down is true, but it's being offset by strength, well, at least partly offset by strength in other areas of the economy, like infrastructure spending is still going on. The manufacturing sector is doing pretty well. China's rapidly becoming a leader in electrical vehicle production, solar panels. So the EV, alternate energy revolution that's going on at this stage, at least China is a major player in the manufacturing sector of all of the things that we need in that area. In terms of geopolitical, will they, they're always rattling the sabers in terms of invading Taiwan. I think that's a pretty, knock on wood, but I mean, I think having seen what's happened to Russia invading Ukraine, it's not a walk in the park to take over Taiwan. They've got to land ships into Taiwan. It's very well defended. I don't think China, it likes to talk tough in this area, but maybe naively, I just don't think China would ever see it in its own interest to invade Taiwan unless things got so bad that they needed a diversion, like a nationalistic diversion. But a bit like what Argentina did all those years ago when their economy was in peril and they invaded the Falkland Islands. But I think it's something we'll talk about, but I don't ever see China wanting to take on trying to take over Taiwan. It's just too big a risk.
Thanks. Fingers crossed. And David, there's one more here for you, just on some comments that you made around the RBA outlook and perhaps them starting to cut sooner than what's anticipated. It's interesting, isn't it? Because 4.35, it's still actually a low rate historical, and this question from a historical point of view, and this question from the audience is, what is the right level of rates?
Yes.
A former RBA governor stated around 5% would be a normal kind of rate. We're still below that, and yet we're talking about these high rates and potentially cutting them. Any thoughts on that?
Yes, well, it's certainly no longer 5%. I mean, that was back in the days when inflation was higher, debt levels were lower. We do know the number. The RBA, I think their sense of what the so-called neutral interest rate is. So the neutral interest rate is the rate that on balance doesn't stimulate the economy or slow it down. It sort of keeps it on an even keel. And these days, the RBA think it's about 2.5%, so like half of the 5%. And it's similar in the US. They think a normal rate going forward is around about 2.5%. So that's where, maybe it's not 2.5, maybe it's 3, but it's certainly less than what it is today, and it's certainly less than 5. So I think a renormalization of interest rates today is rate cuts, bringing them back down toward 3%. Rather than pushing them up to 5.
In times, yeah. Thanks, David. Good. Cameron, there's a question for you here around AI. whenever AI gets mentioned at the moment, it seems ChatGPT is the natural thing that gets talked about, and ChatGPT is great for Microsoft. But what about the implications for the other companies in that NASDAQ and technology space that you spoke about?
Yeah, it's interesting because I guess when ChatGPT came out, the knee-jerk reaction was that Alphabet has a real problem in terms of, the default, obviously, for most people when they, need to find something, they'll go to Google. But now, after years of having a very wide moat and almost impregnable moat, there's an alternative. There's an alternative that may well disrupt Google. And that was also compounded when Google itself tried to launch its own chatbot Bard, which failed to answer some sort of pretty basic questions. So, what I kind of see here is that Google will still have a role to play. So it will not be entirely replaced with whatever ChatGPT becomes. I think that's sort of fundamentally different the way you use those two engines. There is some threat there. But generally speaking, where we're sort of seeing the value add for these companies is not, if you like, in sort of standalone solutions, but in the additive use of AI to existing products. So I talked briefly about Copilot, which is an integrated solution to your Microsoft Office suite. If you were, for example, a web developer and you might use AWS, so Amazon's web service to develop applications and alike, they have AI tools there that are going to assist you in terms of doing that. So it's about these large platforms that have existing solutions using AI to enhance what they already have. We also throughout the year we've seen that Meta has managed to dramatically increase the level of engagement in its applications, and that was through, again, the use of AI. So it's not that they have a separate AI product that people are buying, but using AI as essentially additive to the value of their existing products.
Yeah, excellent. Thanks, Cameron. Good. Adam, Cameron mentioned in discussing AI about some of the funds that he's looking after and the way that he's getting exposure to these various companies. Might be worth just you touching on how these companies are fitting into the apt portfolios for clients. And actually, we have quite an exposure to a lot of this area through our existing portfolios.
Yeah, we have a number of funds that are obviously targeting different areas, some available on sustainable technology, others that obviously focus on artificial intelligence. I think we're seeing that there's leaders in artificial intelligence like Microsoft and Google, but we also realize that artificial intelligence is a bit like the internet probably in the end. Like a lot of companies will benefit from this, both through their operations and their supply chains. So a lot of the funds we look at are looking at implementing artificial intelligence in their operations, and this can go for anything down to like retail, such as Temple & Webster, which is an online retailer that's using it. CBA is using AI in their operations. So we have exposure both in Australia to companies like that, but there's also we have exposure internationally and to the big tech stocks like Microsoft, Amazon as well obviously benefits a lot from some of this. So there's exposure throughout the portfolio that's going to be benefiting from this big trend, which I think will just continue over the next decade. I think this is more than just a flash in the pan. I think this is here and it'll be a conversation that dominates over the next 10 or so years.
Yeah, excellent. And Adam, how do you go assessing all of these risks that are present that we've talked about around the world at the moment and in Australia? And also some of these themes that you spoke about that are going to be here for the next decade or so, but it doesn't mean that the prices of those shares moves in a straight line. Still there's a lot of volatility in there, risk for investors. How do you go managing that and putting that together into a diversified strategy for clients over the long term?
Yeah, so there's two aspects of that. There's aspects where we're obviously picking in direct shares, and through that we can obviously assess what the business operations are. Most businesses now produce sustainability reports, and that kind of highlights risks and opportunities in their business. Things like climate change. You can think of this through things like electricity transmission lines. and fire risk from increased that. There's usually all these risks involved. So I guess with anything, there's a risk versus return trade-off. So it's just ensuring that they have insurance and whether they're taking the steps to obviously prepare for those kind of risks and opportunities. We also look at obviously fund managers. We select managers, and part of that is obviously assessing how they see ESG risks, like environmental social governance. This can include things like flooding in the future from this increased variable weather that can occur. So it's important to understand how they're building that into their models and their valuations. And it's not to say that these assets are worthless. It's noting, where the cash flows are coming from, when they could possibly be at risk, managing that risk, and hopefully, developing their businesses and the investments they select into the future. Businesses evolve over time, and it's just about assessing them, both the managers, how they manage that risk, and when we're picking direct stocks, how the managers of that business are working to prepare their businesses for that disruption.
Yeah, it's interesting stuff. You mentioned a bit about climate change. We might ask that question to the panel in a second, but the next decade or so, what Cameron's spoken about today, artificial intelligence, the development of technology, there's no doubt that's going to be huge and change the way that we live and work and etc. And a lot of companies will no doubt benefit from that. So there's an investment opportunity there. Climate, the transition to greener, cleaner energy, is a theme. Being able to benefit from that from an investment point of view, is interesting and challenging at the moment. One of the interesting spaces that you get a lot of questions from clients about is the electronic vehicle battery transition, and what that means for lithium. And Australia's obviously very strong in lithium mining, and yet, despite that being what's thought of a big theme over the next decade, we've seen a 75% decline in the price of lithium over the last year or so, and those companies' values, taking a massive hit. So it's all about balancing these risks against the returns on offer, Adam, fair to say.
Yes, definitely. It's important to know that something can be large and not necessarily profitable. There's obviously lithium demand is obviously increasing significantly, but we've also seen a bigger shift in increase in demand, supply. Sorry, new mines being developed, and also new technologies. When a commodity gets too expensive, there's sodium-ion batteries being developed that could possibly replace lithium. So it's important just to make sure you're weighing your risks when you're taking those kind of investments, and there's a risk return trade-off with everything. Just being aware.
Yeah, well, that's why we're lucky to have you and your team working 24/7 on this stuff, so thanks. Maybe just before we wrap up, as the last question, just that climate change piece. We've got a couple of questions that have come through around climate change. Just maybe any broad thoughts on climate change, the transition to greener energy, any impacts that you're seeing that have, David, Cameron?
Look, just a quick thought. I think what we're seeing with the case of lithium, for example, is, don't put all your eggs in one basket. With the thematic, the thematic is decarbonisation. We need to reduce the reliance on fossil fuels to reduce greenhouse gas emissions. Now, exactly what the technology will be, the winning technology will be in that regard, is still uncertain. And so, one approach here is, yes, balance your risks and whatnot, but also take a diversified approach to the thematic. Invest across a broad swathe of industries that are working on the problem. We don't know who's going to win, but provided you've got a broad diversification, you've got a good chance that the ultimate winners are going to be in your sort of portfolio. So definitely, look at it from as a thematic. And make sure you've got diversified exposure to that thematic, as distinct from maybe taking a bet on a particular type of technology being the ultimate winner, because things can change.
Yeah, I think that's spot on. If you look at the energy transition material sort of complex, yes, lithium's sort of had bit of a wild ride. The dynamics of supply and demand are very interesting there in terms of the growth in demand, but also the timeframes to build a lithium mine are a little bit shorter than some other materials such as copper and nickel and alike. So taking a diversified approach is definitely one of the keys, we think, to removing some of that volatility, and also looking sort of beyond, like if we even look at, for example, this year, uranium has been a very strong performer. That's going to, clearly after COP28 just last week, going to need to be part of the overall solution. So having that broader approach rather than putting all your eggs in one basket in a specky lithium miner might stand you in better stead over the long term.
That's great. Right, thanks very much. Well, I'm conscious of time, so I think that's probably all we've got time for today. So a big thank you to David and Cameron for giving up your time today and being with us, and thank you to all of our clients for your support during the year and for coming along today. Hope that's been useful. If you do have any other questions, please reach out to your advisor. We'll be sending out a recording of today's events, and we'll try to get an answer to any of the unanswered questions we weren't able to get to today and send that out along with the recording. So we look forward to seeing you all in 2024 and helping you during next year. Wish you all a safe and happy holiday season with family and friends. Thanks very much for your time. Have a good day.
Bye for everyone.
Yeah.